Imagine this scenario. You wake up, you check your stock portfolio, it's down 5%. Immediately you check your Bitcoin and it's down 10%. Just a few years ago, this wouldn't have been a surprise, but it wouldn't have been the norm either. For years, the promise of Bitcoin was simple: diversification. It was digital gold, a hedge against traditional market volatility. When stocks fell, crypto was supposed to hold its own or even rise. But something has fundamentally changed, and the correlation between the S&P 500, the Nasdaq, and Bitcoin has shot through the roof, especially during market downturns. So if they're fundamentally different assets, why are they now acting like twins when the market is scared? The answer lies in three key shifts in the financial world, and we're going to break them down for you now. Reason number one: the risk on, risk off trade. In the eyes of Wall Street, there are safe assets and there are risk assets. When the economy is booming and interest rates are low, money pours into risk on assets. Think of high growth tech stocks, companies that promise huge future profits, and yes, of course, cryptocurrency. However, when the market smells trouble, high inflation, a potential recession, or geopolitical risk, investors shift to a risk off mode. They panic and they seek safety, and they sell risk assets. And here's the kicker: the assets they sell first are those at the end of the risk spectrum. That's why you see the likes of Nvidia, which is valued on future growth, get hit hard, and you see Bitcoin, which has no underlying cash flow, get hit even harder. When fear spreads, institutions aren't looking at the fundamentals of Bitcoin versus the fundamentals of Apple, for example. They are simply selling the most volatile, speculative components of their portfolios to raise cash and reduce risk. They treat speculative tech stocks and crypto as the same panic button. Reason number two is a paradox. The very thing Bitcoin fans celebrated, which was institutional adoption, is what tied it to the stock market. It's no longer retail investors with small wallets buying Bitcoin. We're talking about massive hedge funds, publicly traded companies, and crucially, the launch of the spot Bitcoin ETFs. When an asset manager holds Bitcoin for a client, it's not sitting in isolation. It's part of a huge diversified portfolio alongside stocks, bonds, and commodities. If that fund faces a massive outflow from clients, or if they need to meet a margin call, meaning they need to raise cash fast, they don't just sell one thing, they sell across the board. They liquidate stocks and they liquidate their Bitcoin and Ethereum holdings. And this means that major selling events in the stock market now automatically trigger significant selling in the crypto market, and vice versa, purely due to portfolio mechanics and the need for liquidity from these big players. And remember, this works both ways. Same for stocks with crypto, crypto for stocks. Finally, the third reason is the powerful unifying force of global macroeconomics, centered on the decisions of central banks like the US Federal Reserve. What is the enemy of both speculative tech stocks and assets like Bitcoin? And the answer is high interest rates and quantitative tightening. Think about it. High growth tech stocks are valued on the promise of massive profits years into the future. When interest rates are low, those profits look great. But when interest rates go up, the value of those future earnings are drastically discounted. Bitcoin and crypto, while not cash flow generating assets, thrive on the same cheap money. When the cost of borrowing goes up, the overall pool of excess liquidity that flows into speculation like crypto starts to dry up. So when inflation data is bad, or the Fed signals aggressive rate hikes, or maybe they stop cutting, or they don't cut when everybody expects them to do so, that can create a headwind for the stock market and crypto. The market reprices the risk simultaneously and down they both go. And vice versa, if the Fed starts cutting rates, you can expect stocks to rise and crypto to rise. So to quickly summarize, stocks and Bitcoin are now heavily correlated. They are falling together now because they're considered risk assets by institutional funds. Those funds are selling them in tandem during times of panic. And they are both heavily correlated to actions from the likes of the Federal Reserves and central banks. The bottom line for you is, the investor, that the old promise of Bitcoin as a simple non-correlated hedge is now for now broken. In moments of market panic, you cannot rely on your crypto holdings to provide safety when your stock portfolio is tanking, and vice versa. But this doesn't mean you should abandon it either. It just means your portfolio strategy needs to adapt. True diversification in today's market may require looking beyond crypto and high growth stocks into other assets that genuinely thrive when risk sentiment drops, like certain commodities or short term fixed income. But now you can also use this information to your advantage. If, for example, you're interested in investing in stocks and you feel crypto sell off is coming to an end, well, then you know maybe it's a good time to start buying into equities because of this high correlation, and vice versa. I'd love to get your thoughts on this new correlation between Bitcoin and stocks. Let me know what you think in the comments below. And if you found this content useful, please hit like and subscribe and share if you would like more essential market analysis. Thanks and bye for now.